Burt White is joining us. He's Chief Investment Officer at LPL Financial. Rex Macy is with us. He's Chief Investment Officer at Wilmington Trust. He helps oversee $35 billion in assets. Gentlemen, it is good to have you on the program.
Thanks for having us.
Characterize for us what is going on in this market. How would you characterize where we are right now in the cycle ahead of all of these important events?
Well, I think with the price-earnings ratio that you're seeing on the S&P, the market's already priced in a soft patch. It's priced in weakness, and it's priced in a lot of risk. Risk from Europe, risk from Japan, and risk from the U.S.
So no reason to do anything.
Has it priced the end of QE2?
It's certainly priced the end of QE2. Yeah. That's been forecast for quite some time. The question is what happens. And after the 1.8 GDP number in the first quarter, I'm sure the Fed is waiting to see what happens as well.
What do you think Bernanke is going to say? What are you expecting him to say in 10 minutes?
Well, I wonder how many times he's going to use the word transitory, but I don't think it's going to be on commodities. I think it's going to be on some of these economic activities that are really driving the soft spot, things like the floods, things like Japan coming online, and others. And I think that's what he's going to be talking about, transitory. But I think he's also going to say that we're going to have lower rates for longer, and I think he's going to say that we're not going to get QE3, that there's too many risks for it, and he's going to outline the benefits of not doing it.
But you know what? You can't expect business as usual. We had a worse than expected jobs number on Friday. Just over 50,000 jobs created in the business segment. People were expecting to see the private sector see job creation of well over 100. So what changes today from those comments as a result of what we're seeing in the economy, do you think?
Well, I think one of the things you've got to realize is there's enough liquidity out there. It's not up to the Fed to put more gas out there. It's up to somebody light to ignite the gas that's already out there. So the Fed can only do so much. They're not the only player in the economy, and they can't drive everything. So we do see some weakness, but we also think that, we've had 7 quarters of positive GDP. Nothing is going to be a straight line. And I think what we've seen is a soft patch. We had higher commodities. We've had some bad weather. I think we need to give it some time and see where we go from here.
So what do you do? You're an investor, soft patch. How do you approach it?
Well, we like equities at this point. We still have $98 as a target for the S&P earnings. Given where we are, given where inflation is, we like equities. We particularly like healthcare and technology. We like credit. We think we're in a recovery. We think it's weak. We kind of like the middle of the risk spectrum. We don't want to be in cash. We don't want to be on the aggressive end. We like the mega caps. We like stocks.
Okay. What are you buying here? What do you like?
Be a little bit more defensive. We think that this is a multi-week decline. We've had 5 weeks. We think probably have another 6 or 8 weeks before really some of this data washes it through. Expectations are still too high, obviously. Expectations were 200,000 for jobs, got down to 150. It wasn't even close. So expectations are still too high, and I think that you got to wait for it to move down.
Healthcare, pharmaceuticals?
I'd raise some cash here, but I'd also move to some of the defensives. We'd move into staples, we'd move into healthcare, some of the more defensive names that really don't need the economic growth wins to fill their sails to move forward. We think that those are the better names in this particular part of the cycle.
What if he says, last fall when they announced QE2, when the $600 billion tranche was announced, market took off and didn't look back until this spring. What if he says it's a possibility? If we read the tea leaves and he says that QE3 is a possibility, what happens?
Well, the market will, that's a significant event. That's like a market change. Your market goes up like a rocket ship.
You think it goes up?
Absolutely.
Don't you? Isn't there also an argument to be made that people look at this and say, whoa, things are a lot worse than I thought?
Yes, I think that is a risk. That if he comes out today and says, wow, we got to start thinking about QE3, then I think everyone's going to say, wow, the economy is really a lot worse than we thought. The patient has flatlined again, and I think that's a risk today.
Now, you said you want to raise cash. Raise cash how? What do you want to sell?
I'm not doing a lot now. I'm probably just taking risk down just a tad bit. I'd probably get out of some of the cyclicals. I still think the cyclicals are probably going to, struggle here over this little soft spot. But I wouldn't be too far away because I think that, once we kind of get through the summer, a lot of the July data that's released in August, we think are going to be stronger than expected, and that's the time to get back into cyclicals. And we think that's going to be a wonderful time to get back in this market. And we think the market's probably, got another 5 to 7%, in it for the rest of the year.
All right. Well, we'll know shortly what Mr. Bernanke is going to say. Bert, Rex, good to see you both.
Thank you
for joining us.
Good to see you.
Good to see you.